Some people think that only the wealthy can use tax strategies to save a significant amount of money on their taxes, but this is just not true. In fact, even if you have a middle-class salary, you can still save a ton of money in taxes if you know what strategies to use. So in this video, I'm going to be going over some of the most absolute best tax strategies that the average income earners can use to make more of their hard-earned money come back into their pockets come tax time. Make sure you stay all the way until the end of this video because you do not want to miss any of these strategies. Without further ado, let's dive in. Before we get into the tax strategies, I want to first go over what I mean when I say middle-class salary, because I'm not trying to offend anybody. According to the Bureau of Labor Statistics, there are approximately 119.2 million full-time wage and salary workers in the United States in 2023. The median weekly salary for these workers per week is $1,100. And this translates to about $57,200 worked per year. So this is what I mean when I say middle-class salary, a salary that an average worker could expect to make in America. It doesn't necessarily have to be this exact amount, but let's say that somewhere in a range of about $40,000 to $80,000 per year in income is what we're targeting. I'm not talking about millionaires here, or even people who make over $100,000 and are in the top 18% of earners in the United States. Just average earners. Okay, so let's move on. Number one is retirement accounts. Many people view retirement accounts as just a way to save for retirement, but they are so much more than that. When used correctly, retirement accounts can actually help you to save money on taxes. How? Well, let's look at several different retirement accounts, for example. Let's talk about the 401k. 401ks are one of the best known and most popular retirement accounts in America. They are named after Section 401k of the Internal Revenue Code, and over $6.3 trillion of wealth is held in these accounts.
Damn, okay.
You see, 401ks are employer sponsored. They're defined contribution plans that give you a tax advantage in a way to save for retirement. There are multiple ways that a 401k can benefit you from a tax perspective. For example, for traditional 401ks, you can make 401k contributions on a pre-tax basis. This means that you will be able to deduct your 401k contributions in the year that you make them. Being able to deduct 401k contributions lowers your taxable income for the year. For many people, being able to deduct 401k contributions actually lowers their taxable income enough that pushes them down into a lower tax bracket, which can help them save money in taxes. Another great tax benefit of 401ks is that 401ks earnings accrue on a tax deferred basis. This means that you do not have to pay taxes on the capital gains and dividends that build up in your 401k until you start withdrawing the funds during your retirement. So if you decide to go with a Roth 401k instead of a traditional 401k, there are still significant tax benefits. Let me explain. With a Roth 401k, you can make contributions with after-tax money. This means you don't get a deduction in the year that you make the contribution, but your account will still get to experience tax-free growth. And then when you pull that money out later on in life, when you make withdrawals from your retirement, both those traditional 401ks and Roth 401ks often have impressive tax benefits. The exact tax benefits may differ slightly, but both of these retirement account options can help you to save money in taxes. Let's talk about SEP IRAs. A SEP stands for a simplified employee pension. What a simplified employee pension means is that you have a type of individual retirement account or IRA that can be set up and be funded by yourself if you're a self-employed person. Like 401ks, SEP IRAs have a number of great tax benefits that can help middle-class earners save a significant amount of money on taxes. For example, just like traditional IRAs, a 401k contributions to SEPs are made with pre-tax dollars. This means that you will be able to reduce your taxable income and save on taxes in the short term without having to pay taxes on the SEP IRA until you withdraw it from your retirement later on. Now, another great benefit of SEP IRAs is the fact that the contribution limits are higher than that of traditional IRAs. This is one of the main reasons why many people like these better than normal IRAs. In fact, for 2023, you can contribute 25% of your yearly income or up to $66,000, whichever is less. These high contribution limits can help you experience tremendous tax savings on a yearly basis. SEP IRAs also grow tax-free, so meaning that you won't have to pay taxes on the capital gains or dividends until you retire and withdraw from that money later on, just like a traditional 401k. With SEP IRAs, they are available to businesses of any size, and the contribution amounts are allowed to vary from year to year. Flexible contribution amounts are a good benefit if you're a business owner because maybe your revenues change from year to year, and this is why SEP IRAs are sometimes recommended. Now let's talk about HSAs. HSA stands for Health Savings Account. A health savings account is a special type of savings account that allows you to save money on a pre-tax basis to help you finance qualified medical expenses. So let me explain. HSAs offer a triple tax advantage. Deposits are tax deductible. So when you put money inside of your HSA, you receive a tax deduction. The growth is tax deferred. So you're not paying taxes on the amount of money that's growing in the HSA. And then spending it is tax-free as long as you spend the money in the HSA on qualified medical expenses. So essentially, HSAs are an extremely beneficial and tax-advantaged way to save for medical expenses that you might need to pay for, that you will 100% need to pay for in the future. We are all going to deal with medical issues later on in life. However, keep in mind that you can only contribute to an HSA if you have a high deductible health plan or an HDHP. I'll be discussing that on another video. All right, guys, let's go into option number 2. We talked about retirement accounts. The next thing I want to talk to you about is tax credits and deductions. You see, in addition to retirement accounts, there are a number of key tax credits that can help you save a ton of money on taxes too if you have average income. Here's a quick overview of some of the best tax credits you might be eligible for. Number 1, if you have children, the child tax credit. If you have kids, this might have been one of the best benefits for you because you will receive a $2,000 tax credit per qualifying child. Guys, that's a huge tax credit. It was up during COVID, but it's back down to $2,000, but it still provides some key tax benefits. There are caveats for this credit. For example, to qualify for the child tax credit, your child must be under the age of 17 at the end of the tax year. You also need to make sure that you have more than $2,500 in annual earnings. Additionally, the children must live with you in the United States for at least half the year. The time they live with you does not need to be continuous. For example, your children, they don't have to live with you for 6 months straight. They can live with you for like 3 months at the beginning of the year and maybe 3 months at the end of the year and take time off in between. As long as they live with you for 6 months out of the year, you can claim the child tax credit for them. Another thing to be aware of regarding the child tax credit is that it does not only apply to biological sons and daughters. The child tax credit can also apply to stepchildren and adopted children, but it doesn't stop there. The child tax credit can also apply to grandchildren, foster children, younger siblings, step siblings, and half siblings. So technically, you do not have to even be the parent of the child to claim the child tax credit. The child just has to live with you in your home in the United States for at least half of the year and be dependent on you. The final requirement to claim the child tax credit is that the child must have a valid social security number. So just to understand how much this tax credit can potentially help you, let's say that you have 4 children under the age of 17. In this case, you could claim $8,000 in child tax credits. You see, for many families, this can be quite significant and can be a huge help financially because they're already receiving standard deductions for being head of household or for being married filing joint. When you factor in this child tax credit on top, sometimes it results in huge refund checks that come in the form of direct deposits or come in the form of a check directly to you. How about electrical vehicle tax credits? The electric vehicle tax credit is another fantastic tax credit that can help you save a lot of money. You guys, we all know that vehicle prices have gone up significantly in the past few years. So anything that can help us save some money related to vehicles is a major bonus. Am I right? So the electric vehicle tax credit is a non-refundable tax credit that is available to people who buy qualifying electric vehicles or plug-in hybrid vehicles. For new vehicles, this tax credit can be as high as $7,500, but it's non-refundable tax credits that help you lower your tax bill. If you're trying to look for another tax savings, you might want to look at applying to get an electric vehicle over a gas vehicle, especially knowing that you see the electric vehicle tax credit recently experienced some major changes due to the Inflation Reduction Act. So I made an entirely another video that goes over this in depth, which I'm going to link in the description or somewhere right here. Let's discuss itemized deductions. Itemizing your deductions can be another great way to save money in taxes, especially if you're having a middle-class salary. As many taxpayers are well aware of, when you do your taxes, you have 2 choices when it comes to deductions. You can take the standard deduction or you can itemize your deductions. The standard deduction for 2023 is $13,850. If you take the standard deduction, then your taxable income will be reduced by $13,850. And for some people, this is the best option. However, for many other people, itemizing deductions is the better way to go. And the reason why this is the case is because if you itemize your deductions and add up all of your itemized deductions and it equals to be more than the standard deduction amount, it means you will save more in taxes by itemizing your deductions. If you have a mortgage, then itemizing your deductions can definitely be the better option. This is because your mortgage interest and property taxes alone, which are both deductible, could be sometimes in the thousands of dollars, depending on the properties you have. So when you're thinking about it, that could end up being more than the $13,850 or $26,000 that you might have if you're a married couple, depending on what items you have to deduct. As a tax professional, I can help you find every possible tax write-off that you qualify for. But when it comes to what you are able to deduct, it's also based on your income. If you qualify for enough deductions, or if you have a good-sized mortgage and you're giving money to charity or have medical and dental expenses or gambling earnings or losses, then these deductions can end up outweighing the standard deduction, hence why we itemize. Let's talk about my favorite subject, short-term rentals. You see, the Internal Revenue Code allows you to use losses from short-term rentals to offset income you earn actively, such as your day job.
That's gold, Jerry. Gold!
So having short-term rentals can help you save a significant amount of money in taxes as well. What this essentially means is that you can buy a rental property, such as an apartment, such as a condo, such as a single family home, and rent it out on a short-term basis through Airbnb, VRBO, or any other method. And by doing this, you will be able to deduct certain expenses related to the property from your normal actively earned income. Guys, you will be able to deduct depreciation expenses, which can be quite significant. And this is because the IRS actually lets you deduct the entire cost of the property through depreciation over the course of 27 and a half years. However, if you want to capitalize on these benefits, there are several rules that you have to follow regarding the rental period.
This should be interesting.
For example, you will have to rent your property out for either 7 days or less at a time or 30 days or less at a time. The easiest way to comply with this rule is to rent your property out for 7 days or less at a time. You do this and the IRS allows you to offset your actively earned income with losses from your rental property, as long as you are materially participating. Luckily, it is extremely easy to limit the rental periods to 7 days on sites like Airbnb or VRBO. If you want to rent your property out for more than 7 days at a time, then you can choose to go with the 30 days or less option. However, if you go with this option, you'll have to perform what the IRS calls significant personal services in addition to renting the property out to qualify to use the losses from the rental to offset your active forms of income. For example, you would have to provide substantial services such as like cooking, cleaning, concierge services, entertainment, driving people around, turning over the beds in the morning. The services you provide would have to demonstrate that you are more than materially participating in this business as opposed to just providing capital. If you are willing to provide these additional services, then you can expand your rental periods up to 30 days or even more than that and still qualify for the tax savings that I'm speaking on. How about cost segregation studies? If you want to get even more savings from your rental properties, then you can get a cost segregation study done. You see, a cost segregation study is a study that allows for you to separate the cost of the components of your property and then separate them from the actual building structure for depreciation purposes. Guys, once the cost segs have been segregated, depreciation can be accelerated for the non-structural components, which is your light fixtures, your flooring, your pools, your appliances. I talk about this all the time. So if you get the cost segregation study done for your property, then you could potentially save even more money in taxes. Well, guys, listen, we made it all the way to the end of this video. As you know, there's so much more to learn. I wanted to give you this information. Here's what I want you to walk away with. You can still save a ton of money in taxes, even if you're not the top 1% income earner, okay? You can save money just by being strategic. Number 2, capitalize on tax advantage retirement accounts and savings accounts like with 401ks, SEPs, IRAs, and HSAs. These are some of the best ways to save money in taxes, and having any one of these can help you significantly reduce your taxes this year. And number 3, there are a number of extremely beneficial tax credits and deductions that you can use to lower your tax bill every single year. Prominent examples include the child tax credit, electric vehicle credit, even the earned income tax credit. But finally, use short-term rentals. You can use short-term rentals in combination with the cost segregation study to lower your tax bill. This is how you can build wealth, replace your 9-to-5 income while also reducing your W-2 salary at the same time. If you follow the rules that I'm teaching you here, you will be able to utilize the real estate losses to offset your W-2 income. And this is what I pride myself on teaching. If you would like to learn more about these strategies that I'm discussing as it pertains to real estate, then visit the link below to the Tax Alchemy course. This course is where I teach average Americans like yourself how to legally reduce their tax bill, leveraging the United States tax system legally. If you want to know this information done the right way in a very easy format and being in a community where you can be on coaching calls with me every single week, where I'm guiding you and educating you, and I look forward to seeing you inside of that program. To everybody else, I look forward to seeing you on the next video. Just want to say thank you for joining me. Cheers.